It always catches me off guard.
Yeah.
I'm like, do. But I feel like it's taking a little longer than normal.
Mine says live.
Oh, we are live. I didn't see the live button this time around. Okay, so here we go. I was just saying, oh, now I'm live. So I'm 16-second delayed, evidently. But hi everyone. Super excited to be here today with my friend Kimmy Scotti, who I think I explained this over the internet, but she is quite possibly the smartest person I know, just in terms of building businesses, but also as an investor. So you are going to get the goods from both sides today, which I cannot wait for. But before I dive in with Kimmy, I wanted to quickly remind everybody that we are going to be closing our tech cohort today. And we'll message in. I think it's at 9 PST, midnight EST. So for you night owls, feel free to sign up then. We have such an amazing cohort so far of people that have joined us, and so I think this is going to be one of the best cohorts we've ever had. Although they're all amazing. And so, definitely, if you've been thinking about it, now is your time. Jump in. You need a network in order to navigate the hard decisions and resource questions that you're constantly up against. So without further ado, now I am going to jump into Kimmy, but I'm going to talk a little bit about her background because I think it'll give helpful context as to what we're going to be discussing. But she is a Renaissance woman, and that is truly the definition of who she is, of the business world. She launched several successful brands and also funded some of your favorite companies like Blink Health, Maven, Ula, Hill House Home, and Seed. And she has been the driving force behind unparalleled growth from all angles. She is going to be talking with me today about the realities of fundraising in today's very complicated market, as well as some of her past business experiences. She now has a fund called Neon, and she was previously building and investing as founding partner of 8VC, a prominent technology and life sciences investment firm where she invested in category defining companies including Blink Health, Maven, Ula, Hill House Home, and Seed. And she remains an advisor to 8VC. And we'll talk about this at the end too. But Kimmy, if there are people that can also invest in your fund as an LP, I think that would be amazing as well. So, without further ado, I'm going to get into it. I want to go back to the beginning. My husband just so sweetly brought me a coffee, so I'm going to say thank you to him. But you began your first company at 15 years old. So, you were doing what I feel like Gen Zers are doing before it was cool. And that was a fashion line. And then you've also built successful brands in skincare and healthcare since then. Can you just discuss how you transitioned from one industry to the next, or maybe why you made those transitions?
Yeah, absolutely. First of all, Allie, thank you so much for having me. It's so fun to talk to you always, and now we get to do it like with this great audience.
And I love
Um,
your necklace, by the way.
my
Anybody else notice her neon? So
yeah,
cute.
so fun. It's
So good.
Susan Alexandra, and so was my Jewish star actually, and I love her. And I just had the
Love it.
opportunity actually to have coffee with her the other day for the first time. Someone introduced us and was just like, "You guys are like each other's spirit animal," and I was like,
Aw,
truly so delighted. And she makes such cool Judaica too. So if you're looking for
aw, I love that.
yeah, she's amazing. So first of all, thank you so much. This is so fun. I started a jewelry line actually when I was in high school. I was 15, and I actually built it all the way through college. And all along the way while I was in college, technology was in this really interesting place. I got for the first time an Apple computer, my own when I went to college,
Yeah.
and it came with the first generation of iPod. And then you'll remember this time. Then we got iPod Mini, and then iPad was
Oh, yeah.
rumored, and then Amazon was books, but it was moving away from books, and Facebook was campuses, but it was moving just off campuses. Right when I was graduating, and
Yeah.
there was all this transition around technology, and I was really interested in that. And I started to say, I think I'm going to build a technology company. And I didn't know anything about technology. I knew all the InDesign programs and how to like pimp my MySpace page, with code, as we all did at that time.
Careful, you're aging yourself. Your MySpace page.
I remember though when we all knew how to code a MySpace page for color and
Well,
sound.
I think it's like I was in that weird in between where I knew my Facebook page, but I
Yeah.
actually never was cool enough to like code the MySpace page. So I didn't
We,
create one.
okay, when MySpace was happening, we all had to like low key know how to code to make
Like
it
make it
great.
cool. Yeah.
Yes, exactly. And it's so funny because we didn't know that's what we were doing. It's what we were doing.
Yeah.
And so anyway, all of this was going on at the same time. And the technology I knew how to use was like a Juki sewing machine, right? And
Yeah.
like work at a jewelry bench, right? But
Yeah.
I felt like there was a lot of heat in this industry. And so I ended up saying that out loud to just the right subset of people. And I ended up working inside of a family office building companies. And the founder of that family office gave me two rules when I got there. He said that I could build whatever I wanted. So I was there to build companies, basically, but like help
Mhm.
build things. Um, he said I could build whatever I wanted so long as I didn't spend very much money trying anything and things were built for profitability basically immediately. Those were the rules. And I
Yeah.
thought these are the best two rules I've ever heard. Aren't they kind of the dumbest rules? Because isn't this just the
Like,
regular
is that obvious?
business? Yes, exactly. Because I'd only been
Yeah.
building for cash, right? My whole business, my little business career. And
Yeah.
and that gave me I think permission to try a lot of things. And so we would just build landing pages and drive traffic through them and see what there was demand for and then build things. And ultimately, what that drove is an interest in following the data, right? You can't
Yeah.
really lie to yourself. You put a page up and no one's interested in something and you're driving traffic through it. And
Mhm.
also, once you've launched something, then you could follow sort of where people's interests were and what people were buying or clicking on to tell you what you should build next. And so all of
Right.
those transitions were actually driven by data. They were all driven by sort of little either super loud information overarching that
Yeah.
was like very clear. Oh, we were building a digital magazine business, and all of the affiliate links that were being clicked were healthcare related, were related to prescription discounts. So we
Interesting.
shifted into building in that
Can
space.
you can you walk us through like that exact process? Because I'm just wondering, like, how did you decide what type of landing pages to put up? And then were they all content? And then you'd figure out what people were clicking on, and then you would build into like what exactly did that look like?
So this is a long time ago.
Yeah.
To be fair, I started there in 2007 when I
Yeah.
graduated from college, and so now this is a more done process, and actually it's easier to do now because landing pages are so much easier to set up and cheaper. But what we would actually do is have like let's say you have an idea, right? You're
Yeah.
sitting home, you're listening to our conversation right now, and you've got an idea that you've either not told anybody about, or you're talking about it with your friends over drinks, and you're considering starting a company. What if you could test that idea? What if you could set up a landing page for that product or a few of them with different marketing ideas and different branding treatments, right? And so
Yeah.
then you can actually pay to drive traffic through them. You set up little ads
Yeah.
on various sites, whatever, and you can drive traffic through those and actually see what's working and what's not working. Are
Yeah.
people making it all the way through your checkout flow? And then when you get to the end of your checkout, you just say that there's a waiting list and you're sold out, or that it's coming soon. Are people interacting with one brand over another, or one subtle differentiation of the product over another? All of that is possible. You can
Yeah.
take these things before you go spending a fortune actually building them. And so I would suggest that it's basically like creating an internet based focus group, right?
Yeah.
You strangers who don't care about the outcome. They're only interacting with the product if they actually want it or not. And I think that's a really honest way to assess your idea.
Having product market fit before you launch,
Correct.
right?
Exactly. This is better than a survey. This is real.
Yeah.
They're showing an intent to transact when they
Yeah.
get to the end. You're giving them a credit card page, right? And
Yeah.
so they're showing an intent to transact. I think that's a really also exciting thing to bring a group of investors if that's what you're looking for next.
Yeah, I was going to say, everybody listening, all the time we have consumer brands that are like, how do I, before I'm outlaying all this cash for inventory, actually showing proof of concept, showing traction? Like, what are some data points? And I think that this is such a brilliant way to go about it without outlaying a ton of operating expenses.
Totally. That's exactly right.
I love this.
Yeah.
Okay. So landing pages, everybody. And
Yeah.
then when did you actually make the pivot into investing, Kimmy, and what did that look like?
This is such a great question. So I was building in the year was I think 2012. I was building this prescription affordability company while sitting inside of this family office in New York.
Yeah.
And the company is profitable and it starts throwing off cash. So I get my
Yeah.
first distribution check. Entrepreneurs are not familiar with distribution checks anymore because EBITDA is not as prevalent, but it should be. And so I get my first distribution check, and it's $22,000, I think. And I put it in my bank account, and it sat there for about 5 seconds before I handed it over to the girls at Sakara Life, Danielle, Dubois, and Whitney Tingle. And I met them be- through the business. A really dear friend of ours, Cami, introduced us to one another because he thought that we would really enjoy each other, and he was totally right. We're such close friends, and he, he was interested in me investing in the business and also talking to them about marketing. And that was the first check I wrote. I had in my bank account $25,700, I think, and I spent $25,000. And that business, if you're a fan, it's, you've seen it scale over the last 12, 13 years that we've been involved. But I always say those girls turned me into an investor, and I never looked back. I totally fell in love with the process of investing and the relationship between investor and founder. Yeah. We were tied together, our fates, that we are on the same side now, that I'm literally invested in their success. And they're, there to be on their side as a sounding board, as an extra set of hands. I would have done I will still today do anything for them.
That's amazing. And I think that's also why so many people want you on their cap table. And then I want to hear about like actually going into venture, right? Like what led to that moment. And then I also want to talk about your philosophy, Kimmy, because I feel like your philosophy is a bit different than traditional VC, in that profitability has always been an important metric. Whereas like with VC, as I think a lot of founders that are listening or investors that are listening know, it's all about growth, right? And sort of this growth at all costs historical point of view. So I'd love to hear first the transition to actual institutional investing, getting over to 8VC.
Mm-hmm.
And then on the flip of that, how did you create this philosophy and start to look at your investments?
Yeah, amazing. This is a great question. So, how did I shift into sort of industrial strength venture, sort of what I called it then and still think of it as now? I started angel investing, like I said. I joined New York Angels in New York and started sort of more formally angel investing as well, and collaborating across other angels. So we were a bigger pool of capital when we invested, and I really enjoyed that. And then we were gearing up to sell our prescription affordability company, and I thought, what if I
Were
could.
you CEO of the prescription affordability company at the time?
I was a co-founder, and I ran operations and marketing. Mm-hmm.
Got it.
Yes, there were a great group of co-founders, and it was a small team. We were 28 employees. It was really small. Yeah, amazing team, and so we're gearing up to sell this company. And I have been now angel investing for a couple of years probably. And I was really interested in doing that with more of my time. I wasn't even sure then if I would do it full time, but more of my time. And I started to say it out loud, and I said it out loud to a really dear friend who was a mutual friend of mine. And Joe Lonsdale's my now former partner at APC and continuous dear friend. And he said, come and do it here. He was building Formation 8, his predecessor funds to APC. And so the first fund that we built was a $50 million seed fund that Drew Oting and Jake Medwell, who are both APC partners, and I were building together. And it was meant to be like a feeder fund to Formation 8. It was like a partner of Formation 8. So the first 8VC fund, 8 partners, was that. And ultimately, we joined forces, collapsed the strategies with Joe Lonsdale and Alex Gleasich, and the 5 of us became founding partners of APC. And I had a great time over the last almost decade building with them and learned so much. And I'm excited to apply that to my new firm, Neon.
And talk a little bit about the profitability piece,
Yeah,
Kimmy, and how, like, because again, historically, VCs are not looking at businesses for profitability. How were you able to sort of look at your investments and also at what stage you were investing? Because a
yeah.
lot of times it's just
Hopes
gone
and
all about, pre-seed, and they need to have a certain ownership. And so talk a little bit about it at your philosophy at 8BC and then how it looks at Neon.
Totally. So one of the things that I was struck by is as I was, as I was building our healthcare platform, and I was started to spend more time out in San Francisco and Silicon Valley and meet with other founders, and I was really isolated in New York and in one kind of thinking, build profitability at all costs. Like we were so EBITDA focused, right?
Yeah.
Um, and then I got out to San Francisco. I remember my first trip, and I'm meeting these founders that actually Joe and Drew introduced me to. They were, portfolio companies or and friends of the business. And and they were talking about their growth, and I was asking them about their EBITDA, and they were looking at me like a lunatic. They're like, EBITDA. They're like, no one's ever heard of it out here. And it was
For
such,
those that are listening, can you share what EBITDA is?
yes,
I
it's
think
like,
there's probably a lot of people that don't know.
do you want like actually the definition? Like it's roughly profit, if you could,
Yeah.
you think of it as, but the actual meaning is earnings before interest, taxes, depreciation, and amortization. And it's basically a metric for financial health of a company's cash generation.
Yeah.
Yeah,
Great. Thank you.
perfect. So that is my pet peeve. I actually hate jargon in business, and so thank you so much for that. So anyway, I'm asking this question. I'm getting a lot of blank stares. And I think that, you really have to balance things because growth is really important, right? You
Yeah.
do, especially when you're building, things are early stage and, you're an innovative company, you do have to gain market share and growth is really important. But I don't believe in growth at all costs. I truly believe you have to balance, building a great business and strong unit economics with that growth. Because the truth is, and now we've seen this over the last couple of years, investor sentiment changes when the market changes, right? And we keep hearing about how impossible it is to raise money. That's not true. Nobody listen to that. It's not impossible to raise money. It's impossible to raise money right now, and the market is so tough. And investors really want to see XYZ. I'll tell you a secret. Investors' sentiment changes, and the XYZ is going to be different year to year, or like maybe not every single year, but like every 2 or 3 years. I have seen it really shift. And you actually still have to build a healthy business. And so if you do not have control of your unit economics, you cannot build a healthy business and you will lose control of your business. When you hear that companies are doing major down rounds or a founder was forced out or fired as a CEO or something like that, the general reasoning behind all of that and all of those situations is that they lost control of their business, and losing control of your business tends to start with losing control of the economics in your business, the unit economics, and overspending. And so regardless of what investors are telling you, you have a fiduciary responsibility to your company, which means your investors, yourself, your shareholders, your stakeholders, right? Your employees, your customers, to build healthy and and for as long as you can and as big as you can. And that means not necessarily listening to growth at all costs, right? Losing money hand over fist while you add customers who mean, who literally mean nothing to your business. What is a customer if every dollar, if every $2 they spend, you have to spend $4 to serve
Yeah,
them?
Kimmy, I was going to say, speaking of metrics, right? Some people might not be familiar with unit economics. So if you can share what unit economics are, and then when you're thinking about a tech business, because I'm sure there's probably a lot of tech founders on here too,
Mhm.
how do you think about unit economics in a tech business? And do you also use that same filter of profitability?
Sure. These things are all. Oh, thank you so much. So nice when these little notes pop up. So business by business, the metrics are going to be different. So I'm just going to give you sort of like a rough concept, which is the
Yeah.
costs of delivering whatever your service are have to be
Mhm.
lower than whatever you're selling those services or products for, right?
Mhm.
So if you are, and like, so in a product business, this is pretty simple. You make something that costs $10 and you sell it for $40. Everyone understands this concept, but also there's your staff costs and marketing costs and all of these things.
Yep.
You have to figure out a cost structure of your business. That means you're building profitability into your model, right?
Yeah.
And it's hard because you want to tell yourself a story that marketing costs over time will come down as your brand is better known. It's not true.
It
Everyone
actually goes up, right?
literally goes up. Yeah.
Yeah.
Everyone projects it that way, right? It's actually my first red flag when a founder is pitching their consumer company and they're projecting that marketing costs will come down over time. I'm like, they don't know anything about the space, right? This is alarming. And so you have to know that whatever your marketing costs are today, they aren't coming down. They're going up. Because remember, wherever you're marketing, they are also projecting that their costs are that their revenue is going to go up, right? And so, if you were marketing on Facebook 10 years ago and you're marketing on Facebook today, your costs didn't come down, right? And so
Yeah.
I think this is actually a really important thing to remember. You're spending inside of somebody else's business to acquire your customers generally, and they are projecting things are going up and to the right for their investors.
Mhm.
And so remember that in your mind. So unit economics generally are the costs of whatever you're doing business is, and then your revenue and sort of the space between those things or your potential for profit. And so, anything you want to add there? I feel like
Yeah,
I'm
no, I think that's great. And I think what, because I've modeled in tech businesses before, and I've always been like, what is going to go into my unit economics, right? Like, how do I think about my cost structure? Because a lot of times you'll have an enterprise sales business, right? So I'm like, usually like your SG&A sits in one place. I'm like, could it theoretically sit in another part of it? So that might be getting a little too technical
these
for
are
everybody on here.
accounting issues, but I actually generally think the more, like, especially when you're presenting to investors, the more you fully load in, the more honest it feels, right? So
Yeah.
a lot of times when you're projecting your
The more
market,
you can beat your projections, by the
correct,
way, which is awesome.
which is also great. But
Yeah.
sometimes I'm looking at somebody's marketing costs, right? They're sharing with me their CAC, right? Their CAC is customer acquisition costs, and I'm like, oh, the CAC's $30. Then you dig into the number. It's actually a blended CAC. They're blending both their paid marketing with their organic marketing. 80% of their business is organic right now because it's small, right? And they're not spending very much on marketing. Then you're like, okay, well, that $30, just became, $80. And then on top or more, I'm like doing math badly in my mind, but then on top of that, they stripped out the cost of their marketing team, right? They're only including variable costs. Okay, now that number is $110. Okay, well, guess what? Their product price is $100, and the average order value is $100. So now they're overspending,
Yeah.
and they're telling a story that, oh, but that person's going to come back and buy something else. We don't know that yet. You've only been in business for 6 months. What if they only want one of these things? And so, or what if they got it and they didn't love it? And maybe they buy 10. We don't know the answer yet, but you have to build a business, that you currently have. You have to be optimistic about the future, but managing your costs in the present. And so that's something I'm always working on. How do you turn an eye towards optimism and future growth while also managing your business in a sound way so that in 6 months you will have a business, right? That's like, what's
Yeah.
the point? The point is that it's like almost like, it's actually like healthcare in a lot of ways. Like, the longer you can stay alive, the longer you can stay alive, actually. That's the
Yeah.
truth of business also. Every new day is an opportunity for, like, more time to figure things out, more time to figure growth, more time to figure out your product market fit, whatever it is. And so your job is to preserve enough capital and to keep your unit economics enough in check that you can do that,
And I
right?
think I couldn't agree more on this. And I think that it's super helpful for us all to hear. If you also have a financially sound business, not only is this great for investors, this is great for you, because then you don't necessarily need investors because you know you could keep going without them. And
Exactly.
that's when they're going to want you most. And that's when you're going to get the best in most advantageous terms for your business,
There
because
is
you're only going to raise opportunistically.
there is nothing worse than needing capital when you need capital. Literally. If you are trying to fundraise because you're going to be out of money shortly, that is the worst place to be, right?
Yeah.
And of course it's so hard. Know that I have both needed capital when my business was not doing well, and also been involved in tons of companies that needed capital when they were suffering for one reason or another, market change, COVID, whatever it was.
Yeah.
Um, but the more you can keep the sort of these matters within your control, the more you keep control of your business. This is how you end up owning a lot of your company at exit, right? Is
Mhm.
because you were able to keep costs in check. You didn't really need capital when you were looking for it. You were shopping for capital because you needed it for growth, or to add another business line, or for a pivot that you saw coming, or something like that,
Yeah.
versus I have 2 months of runway left and I need 18 months more runway to figure this out. That's the worst time to raise capital. And so you really want to, as best you can, and know that I know this is the real challenge, and this, I'm not saying something easy, as best you can, manage your costs such that you can keep control of your business, so that you get to keep control of your business, right? Who doesn't want to
Maybe you
sell?
have to keep it smaller, by the way.
It might mean keeping it smaller. You'd
You know,
much rather, yeah, you'd much rather sell your company, by the way, for $100 million, owning 100% of it, than $500 million and you own 2% of it, right? Because you sell so much to get it there, right?
yeah. And then you also get in trouble of your next valuation has to be so high
Yes.
in order for you to make money on the exit, that you end up doing things that are sort of like, somebody described it in a past life at a previous company, that we had taken in a lot of capital at a really high valuation. And she described us like foie gras, like we were just fattening ourselves up as much as possible, and it was just so unhealthy. And then your company starts to break apart because it just sort of can't grow at that rate. So I think that, I love Kimmy for having these conversations and actually knowing the realities of, like, again, how hard it is to do what you guys are doing. But if you can keep control of your finances, even if it is growing at a much slower rate, you're gonna protect yourself and your business, and you're gonna have a lot more control at the end of the day. I want to talk about the stage piece as well, because I think it's very interesting. You're one of the few investors that I know, and funds that I know, that will actually follow on in multiple stages. So I want to talk about why that's important to you,
Mhm.
and sort of how you made that decision. And then also more broadly about Neon and your strategy there, the types of businesses you invest in, et cetera.
Totally. Thank you so much. So one of the things that I found when I made this like shift from like operator founder into investing is I thought this was really strange. So the way things usually work is I invest in the seed round of a company, and then Allie invests in the A round of that same company, and you lead the A and I lead the seed. So you prove to my investors I'm a genius. And also you're whittling away at my ownership unless I'm contributing my pro rata, sort of my share of that round, to keep my
Mhm.
ownership for everyone at home. And then Avery invests in the B round. She leads that, and she proves to your investors you're a genius, right? And that it goes around like this, it's like a circle.
Yeah.
Well, I was there first, and I had 100% information and access. And if I was paying attention, I could probably see the inflection point coming before it did, right? Before you needed the capital and were that much bigger, I could see that it was coming if we were sort of digging into the data and spending enough time on this. And I've always thought this was strange, because I'm like, why would I let my competitor lead a financing in my best company, right?
Yeah.
It doesn't make any sense. And so in a sort of unique way, and some funds do this, especially at seed and A, but they rarely do it seed A, B, C, like sort of keep on following on like this. And in some companies, like in the case of Hill House, I led the seed, I led the A, both from APC, by the way, and then I co-led the B with another investor, continuing to build ownership. and put more money in after that as well. And so there's some companies that are on my track record where I led every financing until they were either until now, and now we'll see, or until they were very scaled, continuing to build ownership throughout, or either building or maintaining my ownership, mostly building. And I think that it's really important because, first of all, it's the most founder friendly way, I think, to sort of have a relationship with a founder, right?
Yeah. You're in it for long term. Person
You're
that believed in you in the beginning. Yeah. As a partner. Yeah.
This ties us together 100%, basically. Like, my fate and your fate are tied. I have double down, triple down, quadruple down in some cases into your company. Sometimes where your investors are going, are you insane? Like, this is a lot of capital for this company. And you're like, listen, I see what's coming here, and for XYZ reason, I can explain myself, and sort of the strategy. But I think it's a unique way to invest. And I would describe it as very conviction driven and concentrated as an approach. And that is a bit unique to the way we do things at Neon. And it's how I really like to work as an investor, but it also works for me as an operator because it means I can spend more time on the things I'm the most heavily invested in. And not everyone has something to offer the companies they're investing in the way that we do, right? They're not all operators. They don't all have something to sort of offer at all of these different stages. We're unique in that we do. And so we really lean into that as a strategy. It also means that maybe you're the only actual VC on the cap table. People are very nervous about that sometimes. I am not. I've seen the other side. I've sort of seen what other investors say on boards, and there are a lot of great investors out there. But I trust us and our skill set 100%. And this concentrated conviction-based approach, conviction based on the underlying operating business, not who else is investing and who else is around the table, but actually what does this company look like and what do we think is possible here and how can we help? Those things I will, sort of drive my conviction all day, right?
I love that. And then in terms of the types of industries that you go into, does it, since you are very conviction based and also operator focused, do you invest primarily in the businesses that you have experience in?
Yeah.
And like, how are you thinking about your portfolio construction and industry wise?
Totally. So we basically say we're 90% healthcare. And I describe our healthcare focus as the overlap between healthcare and consumer. And what I mean by that is not necessarily that it's D2C healthcare, though it sometimes is. And a lot of you will sort of see me invest in those companies. And some of the companies talked about in my bio are that. But it means for me that we put the patient, the customer, at the center of whatever the product is. And we try to create alignment between patient, provider, so the doctors or whoever's care delivery, and payers, insurers, the government, et cetera, to try to drive better outcomes for the patient or the customer and lower costs for the payers. And so I think thank you, Karen. I think all of that is sort of possible across products and services. It's possible in different areas of healthcare. We spend a lot of our time in pharma, in what we describe as like the pharma industrial complex, the business of pharma, not biotech. Mm-hmm.
Got it.
Yes.
And then how are you evaluating investments today, with Neon versus like 5 years ago? Or are you evaluating them in the same way, but just using slightly different metrics? Can you speak a little bit about your sort of diligence process and benchmarks?
Yeah, it's interesting. I learned it's like maybe not like 5 years ago so different, but maybe like 10 years ago really different. One of the things I had to learn as an operator going into investing is that just because I think everything is operable does not mean the team that's trying to build it is the right team for the job. I'm like, this is
call that the chocolate souffle problem at have you heard this?
No.
And so Angel Track with First Round Capital, I did their program with a bunch of angels, and all the angels are operators. And they call it the chocolate souffle problem, in that with all of these ingredients, you as an operator would make chocolate souffle.
Correct.
They might be making a brownie.
Yes.
or not even a brownie, right?
They
And
might
so
be the
you
best.
kind of
Yeah, in the kitchen.
chocolate chip place.
That's hilarious. Exactly that. So, as an operator, you have a tendency to problem solve sort of ahead of things, right? You look
Yeah,
like how often are you with your kids and they're doing something and you can like see the fix and you have to hold back from fixing it because you actually need them to solve their own problem, right?
yeah,
I have twin boys, they're 3.5. An excavator is broken. They're trying to work the track on, and I could jump in 1 second, fix it. Or I could let them tinker with it for 20 minutes and try to fix it themselves. And when they're done actually doing it, they will be super proud, right?
yeah,
There's that in that's sort of that analogous thing in parenting that I think is true. In business, you actually have to jump in and help people, to like show them how to fix it. Honestly, most of the time, otherwise you're like left twiddling your thumbs on the sideline, watching your business hit a wall because it ran out of money while they're trying to fix that track on the excavator. But they might not even see the excavator is broken.
yeah,
Is the case. You see it because you're an experienced operator. You've been identifying these problems for a long time, and
yeah,
that's you. And so I had to really learn that just because something is operable doesn't mean that this is the operator to fix it. And
yeah,
you actually don't have time to fix everything. And you might be busy doing something else or making a new investment or in a solving a problem with a different company and not even be able to see it right then until it's too late. Right. And so you really have to you have to diligence not just like, oh, is this the market and an idea that is sort of interesting, but also is this the right team to fix it? Why? Sort of answer those questions for yourself, and also is the way that they think about building the business when you look at their business model. And I'll talk about this in a second. The way that sort of the world sort of like maps back to sort of the universe, right? Like
hmm,
business model is just a way to understand, especially before a business launches, how they think about things. How do these founders and this team think about scaling the business, and does it map to reality or not? Right?
right.
Are the marketing costs going down over the next 10 years? Do they think they're going to get 100% of a market share? Like what percentage of the market or do they have to win to make this business work? Right? Are the costs in line with where you understand business costs to be in their space? All these different things you have to think about, and you're balancing as a founder being optimistic and sort of knowing that you have a big idea and that you can capture some part of the market, and being realistic so that I know you're not insane, and that there's that okay, you're trying to get half a point of the market and that's a multi-billion-dollar business. Great, that makes sense. Are you trying to get 110% of a market and there's less customers than you're projecting? That's insane.
Yeah,
So that's, I think, when you're thinking about your business model, and this is, I think, it's more important than your deck. I think it's more important than almost anything. Know that what sort of that's being compared to is a sense of what is possible. Is this breaking physics to work or not?
yeah.
And I think that's really important.
And that you feel like has changed over the last 10 years.
For me, it's
Yeah.
changed. For me, it's changed because
Just because you have more information
I have
about
more.
like, what does work.
Exactly. I have way more information and experience now. Now I know that just because I'm a hammer, everything's not a nail, right?
Right.
And also, the other thing about that, I'll just say one more thing. Not
Yeah.
every problem do I personally want to work on, right?
Yeah.
But when you're going to make an investment, there are sort of like new budding investors on the call, know that you're going to have to talk about this thing at some point at 3 a.m. Like, and think about that. Do you like one time I was looking at a business that was like in the funeral services space, and I was like, do I
Yeah.
want to think about this at 3 o'clock in the morning? No, I don't actually. You might love
I
it.
love that as like the question you ask yourself.
Yes, I actually think it's a really important question, because when everyone's honeymooning and you're in love with the idea and like I'm always in danger of like leaving with the founders because I'm overly inspired by the founders. I'm
Yeah.
like obsessed with the idea, and the founder's so charismatic, and everything's so exciting, and the size of the business looks so interesting, and the size of the market is growing, and all these things, and you're like, wow, you call us being pregnant with the idea. Then you're like, what if this was all going wrong? Right?
Yeah.
If this was all going wrong, do I still want to talk about this? And if the answer is no, it's going to go wrong, all of it, most of it at some point,
Yeah.
for a little while. Like, you built a lot of things go sideways. And you're like, when it's going sideways and I'm going to be excited about this, it's funeral services. I think no.
But I love that you think about it that way too, because I think there are probably a lot of investors out there that are purely, looking at the finances and sort of evaluating the business on 100% almost analytical level,
Mhm.
and don't realize also what it takes from an operational capacity perspective. I do want to go back to the operational piece
Totally.
and the team and
Mhm.
figure out, like, how have you found, like, how do you assess the team, for those who are founders on the call, on
Okay,
like assessing their own ability to build something
totally.
and the model versus, what, like, the idea.
Totally. Okay. So I actually think the idea is not as important. It also depends on what stage the company's at, but let's just say
Yeah.
early. I bet most of the founders that are on this call are probably early-ish stage. Um, you're assessing the team, and the question I'm trying to answer is: can this founder or these founders attract talent to their team
Mhm.
when they can't even pay for it, right?
Yeah.
Advisors and employees, are they coming and lining up to work with these people because they are so charismatic, because they're building something incredible, because they're able to story tell in a way that makes people want to come and be on their side and put wind at their back, right? So can you attract talent, all different kinds of talent? And the other question is, can you create unfair advantages for yourself? Oh, you don't even have a product, but CVS has signed you up to roll out to 8,900 stores. That's an unfair advantage. You lined up manufacturing, you don't have a dollar in the bank. What can you get done with very, very little is the question you're trying to answer at almost every stage of the business, but especially
Yeah.
when you're very early.
Right. When you have no money
Because
and no resources, you have yourself.
yeah, that's exactly right. You don't have nothing. You have you, right?
Yeah.
And so
Yeah.
I think that's really important.
Um, I feel like we've already kind of answered this. I was going to ask about, with investors being a little bit more risk averse right now, what steps can founders take to mitigate risk and increase investor confidence? But I
Yeah.
want to kind of rephrase that question on specifically for women.
Mhm.
Women are having a little bit more challenge than their male counterparts in raising capital, and it's taking longer right now to get capital. What do you see in women that come to raise capital from you versus men, perhaps? And like, what advice would you give female founders in their approach? Because I have sort of my own thoughts on this, but I feel like you would have some really good feedback.
Yeah. I think this is a really good question. And also it's hard because you want this not to be true, right? So
Mhm.
badly.
Yeah.
But it is true. Women are having a harder time raising money. And in down markets, when capital sort of dries up, this about the same amount of capital is invested, but it goes into sort of more traditional feeling founders, right? So
Yeah.
more white men raise more money, and women and founders of color, et cetera, raise less money. And
Yeah.
I think that's obviously a challenge. But so number one, I have a hot take on this situation,
Yeah.
which is I actually think money should be hard to raise. And I think a lot of people got very used to money being easy to raise. And I think we actually are going to build better companies in a market where capital is constrained. And so keep
I
that in the
love
back of your mind. It should be harder to raise. It should take 14 meetings. It should take a bunch of models. It should take a lot of explaining yourself. It should take, you going in and inspiring a team to be on your side, right? All that is true. So when you're like, oh, it's so hard to raise money now, try to reframe it for yourself into like a silver lining like that. But I would say this: I think the most important thing you can do is both have a risk averse model that if I only can raise this much money, this is what I could possibly do with this much, but also a pie in the sky model. If I could raise enough capital that gets me to profitability, how much capital is that? What does the business look like over that time? So make multiple models for yourself based on different amounts of capital being raised or no capital being raised, right? If I raise
it.
nothing, I'm still going to build this company and it's going to look like this. If I raise the $5 million that I'm looking for, it's going to look like this. And have multiple versions of this. And you might, by the way, be in one version of a model for a little while, and then you might raise the money and kick into the next version. But get the muscle of building those models and creating those different concepts of reality for yourself so that they're there, right? They're like in the hopper, and you're constantly adjusting them, so that no matter what's going on, you have sort of a map to sort of what you're thinking. And I think that's really important. I think investors, like, I really like to see that. Like, hey, you're not raising it. Look, one of the things that happens a lot is somebody comes to raise capital and it's not enough capital, right? I'm like, what are you going to do with $1 million? That's no, like, that is for this particular business, not enough. And then they're like, oh, if somebody's like, you know what, I have a model for $7 million, which is actually what I need. I love that. I'm like, great. And they might get all of it. They might, by the way, I might be more interested in the model that's raising 7 million than I am in the model that's raising 700,000. And so know that that's the case. Playing small isn't necessarily playing smart all the time. Having a fully funded model, a concept of this is all the capital I need and I can get to profitability on it, and this scale and this sort of version of enterprise value that I'm thinking about, that might be the better version. It's a lot more money. It might be easier to raise.
Yeah. I love that so much. And I love the fact that you keep, Kimmy, talking about models. And if you are going out to raise capital, most likely you've built a model. But I think there's also a lot of founders who I'll ask, like, you know, do you forecast? Do you model? And we talk about this a lot inside of FFC. If you have a model and you watch it each week and you're forecasting out, your likelihood of going under as a business becomes very low.
Totally.
I think a lot of the reasons that businesses fail is they don't have this. They're not projecting out. They're not scenario planning. And by the way, it's not that expensive to get a model done and to go to an outsourced CFO. You don't have to do it yourself. Right. I think a lot of people are like, well, I'm not a financial person.
Right. But it's actually a financial person.
Yeah.
But also someone's boyfriend is a banker somewhere, or someone's sister. Like, there is someone in your network who is a whiz at Excel who can help you figure this out. I would actually say, don't let your like outsourced accounting team build it. I've seen this before and it's a red flag for me when somebody else has built the model.
Well, you have to drive it.
You have to drive it.
But have the technical skills, but like, yes, you need to know all the assumptions that are being put in there and why.
But make someone show you how to do it. You'll feel, it feels scary. You're looking at a blank Excel page. Like, what am I doing here? Every formula is available on YouTube. Truly. Yeah. Everything's available on YouTube. You can easily figure out building a model. I promise. The tools are out there, and also like there is definitely someone in your network. Even in my like early network, I didn't have any business people in my network. You have to be, I just like sat on a computer until it worked, basically. And you just have to be able to figure this out. And that's one of those unfair advantages you can create for yourself. Go sit in a bar on Stone Street if you're in New York, and like find a cute banker and make him show you how to build a model.
Truly. It's magical too. And it becomes fun. Yes. Because you realize in how much control you are. It's like your control pad and all the levers of your business. Totally. And you're like, oh, this is fun. I can drive this and I can actually control the outcome, as opposed to feeling like it's controlling me. Totally. So I absolutely love that. Kimmy, you have the most insightful, real advice. And yes, somebody's saying, did Kimmy just teach me all the things I forgot from my Kellogg MBA? I do feel like sitting down with Kimmy is like getting your MBA. You want investors like this on your cap table, but also like, yes to putting money behind a VC who understands both sides of the table. I think it's so important, because you can empathize with what it's actually like, and if somebody puts in their model that they're going to hire 40 people in a month, like that's just not going to happen, or you're not going to get good quality. So love this, Kimmy. Everybody build a model. Kimmy, where can everyone find you?
You can slide into my DMs on Instagram at Kimmy Scotti is an easy place to find me.
If they want to pitch Neon, or if they want to invest in Neon.
All of it, all the above. And also you can email me at kimmy@withneon.com.
Awesome. Kimmy, you are the absolute best. So appreciate you. Everyone, thank you for joining. Again, we are closing out today for 10th House Tech Cohort. So join us for more conversations like these and actually getting nitty gritty insight on what different models can look like. We hope you'll join. And again, Kimmy, you're the best. Thank you so much.
So fun. Bye.
Bye, everyone.